US stock indices managed to claw back all of their losses following the Liberation Day announcement on April 2nd. Brent crude oil prices as well tanked as the markets opened this Sunday. What's happening in the world economy and what's happening with the markets? That is what we'll cover in the next couple of minutes. Before we start though, as always, I need to stress that trading financial markets unfortunately is high risk and we may lose all of our invested money. Moreover, I will share my opinion on the markets, but this does not make it investment advice. It's merely done for educational purpose. If you haven't read this before, pause now and read it now. So, what happened last week? Let's begin with the economics. So, US GDP contracted. It declined by 0.3% annualized, which is obviously not great news and is a bit of a shame for Trump. Up until recently has been calling the US economy very strong, and that's because of him. But now when the economy contracted, he blamed Biden. Although the reason for this contraction is quite straightforward. A lot of US companies decided to import during Q1 to avoid Trump's tariffs. And when you import too much, then that will detract from your GDP, and that's why you have that negative reading. And the fact that there is negative reading is obviously not something that a president does not want to be associated with. If he now has double quarter of negative economic growth, then it will be what we call a recession, a technical recession. But there's more to it than just GDP. What is important when they decide if we're in a recession or not is what the labor market is doing. So let's take a look at the labor market. Last week we had the latest reading from JOLTS, and you can see that job openings declined after being above 7 million, closer to say 7.5 million new jobs per month, and they declined to 7.19, and we're back at the levels we saw before the pandemic. It's not bad, but it's obviously not great because we have a well-defined decline here. Now that makes a lot of sense because on the back of COVID, there was a lot of changes in the economy. What else? ADP. So ADP was disappointing. It came in at 64K versus 114K anticipated. That caused stock markets to slide a bit, and then they were able to recuperate the losses. The market pretty much ignored this. 64K, of course, is not a good reading. And on Friday, we had non-farm payrolls. So non-farm payrolls saved the situation because the outcome was 117K, which is higher than the 138K anticipated. And also the unemployment remained unchanged at 4.2%. So what was the stock market's reaction? So if we look here, this is the Nasdaq 100, this is the Liberation Day, the market collapses. And the reason for the collapse here is all due to Trump and his policies. All these tariffs that were put in place caused the market to decline, because if these tariffs would have remained at very elevated levels, then we would have seen tariffs at levels we wouldn't have seen for the last sort of 90 years or so. Back then we had the Great Depression. Now, slowly, as Trump and his team realized that this was enough to motivate people to negotiate, and as well as he saw that the market was coming apart, they decided to step back from these tariffs. And that is why we had that push to the upside and then slide and then upwards now. And what's interesting again is that the non-farm payrolls, at least, the labor market has held up relatively well despite the current conditions. And that is what's happening. And as we look forward now to Q2, investors think that we'll see GDP increase by 2%, which is obviously great if that could happen. So from a technical point of view, with all this happening, it's really important to understand that we still have tariffs in place, and we will probably have some problem with the economy down the line if this is allowed to continue. And that means that there is a risk that we could potentially trade slightly lower at one point. As well, we are at that critical 200-day moving average, and if we don't break above there, in particular break above 20,555, then there's a risk that we can go to the downside. So how should we deal with this in a clever way? We don't necessarily want to be buying just at resistance. I would prefer to buy closer to support at 19,393. So buying between that level and this level here makes far more sense to me than looking to buy up here. Now, of course, if we break above here, maybe we can engage, but maybe it's better to engage on a corrective move. This little line here is where we were last week. Last week I said if we break above here, we can go to the upside. How about Bitcoin? So Bitcoin is interesting because Bitcoin bottomed out before stock market indices and it was able to push higher. And also they have now peaked to some extent before the Nasdaq 100. And what's interesting here is that we're creating a swing high here, which makes a lot of sense. We went up and we needed to take a bit of a break, and then the price is now taking that break. Now, if we break above 98 points, call it $99,000 per Bitcoin, then that will be very interesting as you break here and we can push to the upside. The alternative is that we dip the 200 moving average and 89 and 85K in between these two levels. I think the risk reward ratio looks good. But there are problems. If, for example, jobless claims, which came in bad last week, it comes in weak this time around as well, and we have the ISM services out today as well. If they come in weak, it could potentially cause things to slide to the downside. But realistically, the way things are going, there's talks that the US might lower tariffs on China to 60% over the next couple of weeks, and that obviously would be great. So overall, we're going to keep on buying dips. In the case of EURUSD, the situation here is a bit more complicated because the ECB is probably going to cut rates quite soon again, and the Fed is not cutting rates because of high inflation or perceived high inflation coming in the US because of the tariffs. So it's a bit of a difficult situation. The price hasn't really changed too much since we looked at this last week, and as long as you trade above 112.50, I want to be bullish. There's a few reasons for this. Firstly, Germany is expanding its economy with all this infrastructure investing, and EU in general is investing more money, whereas in the US, they're looking to reduce the government, and that is a form of austerity which has the opposite effect. So bullish for now, but we need to be a bit careful. I think if you just look at this, it's actually quite easy to understand that if we break below 112.50, then we can have a bit of quite a few people stopped out, then we can have quite an easy slide towards 110.67. In the case of gold, so we spiked to the upside because Trump wants to get rid of Jerome Powell. You have as well problems in general, but that has now abated because it's very clear now that Trump is going to continue to back down, and we might even have some trade deals with some countries. And that is pulling the support out of the feet for gold bucks. But technically, we remain bullish above 3,187, and I want to be bullish between these two levels. Last week, we pretty much looked at the same levels, and we looked at this as a stop. So things have not really changed. And what's interesting is sometimes if you looked at the Nasdaq 100, which I just showed you, it's not a level where you want to buy it. If anything, you want to start to turn bearish at these levels technically. And this again is a very close of breaking some interesting levels. And what happens many times is that you have a bullish move and then you get a news, or you have some news that motivates this, if that makes sense. For example, in terms of, because if you look at this, it's a clear uptrend, right? So when you are in an uptrend, you tend to get news that sort of enforces that uptrend, okay? Instead of getting things that completely goes against it. So I would bet that something is going to happen this week that could potentially lift this to the upside. How about Brent crude oil? So a couple of weeks ago, we said that the price was bullish, but a break here can take you to the downside. That went spot on. We said break here, turn things bearish, and we did indeed decline. And then we had this gap over the weekend. Why? Because OPEC, surprisingly, decided to increase output by 411,000 new barrels per day starting from June. This makes a total of 44% unwinding of the 2.2 million barrels per day cut that they introduced a couple of years ago. These are the calculations from Reuters. And what's interesting here is that this unwinding here effectively means that there's more oil on the market. And if you have more oil on the market, you tend to see prices slide to the downside. And that's exactly what we're having here. But it's happening at a time when the world economy is slowing. So they don't necessarily have to do this, I would argue, given the way prices are looking. I think what they're trying to do here is they're trying to please Trump, or they just feel that they want to be a bit helpful and just lower the energy costs for everyone. For me, I obviously see this as something welcome, and I think most people do that as well because it will boost the economy down the line. Going forward, given that we're still dealing with tariffs, and given that both the US and Chinese economies are not going to leap and do like extremely strong growth in the very short term, even if they would remove tariffs, then I would continue to be bearish below this high, which is 62.65. So bearish between 61.21 and 62.65. And what can we look forward to this week? Today you have the ISM services. You definitely want to keep an eye on that. The US economy is like 70-80% just services. So this is something really key that you want to keep an eye on. And then on Wednesday, the Fed is not going to cut. Probably it's going to leave rates at 4.5%. And the probability of a cut is just at 7%. People still think, though, that we might have a cut in June. So what do we want to keep an eye on? We want to see what they think about tariffs, about the current situation, because we had US core PCE dropping from 3% to 2.6%. So we have had improvements on the inflation front. The question is if the Fed is going to take and mention this now, or if they're going to do what they have done recently, which is they want to wait and see. And I think that's really the interesting bit. I think they will probably continue to wait and see. Some experts say that by the end of this month, we will probably start to see the impact of some of these tariffs on inflation and in the US economy. If you look at the PMIs, they have indicated that input costs have increased. So inflation is probably coming down the line. Just the Fed wants to know how to deal with it. How high is it going to be, if any? Bank of England going to cut. So you definitely want to keep an eye on that for the GBP-USD and GBP-Yen. And as well, on Friday, you have Canadian open payrolls. It's an interesting thing because you usually have this data out at the same time as you have the US NFPs, but now you have it separately, which gives an opportunity to trade the Canadian dollar. So if you like to trade news, like to trade breakouts, keep an eye on both Bank of England and the Canadian NFP on Friday at 1:30 p.m. London time. This ends this update. We'll be back next week for another update. Goodbye.